Let's move on to part B of question 1. Part B of question 1, which says, Dansoft Limited is a juice processing firm which is solely equity financed. The company's board of directors are considering diversifying their operations by entering into the soda processing industry. Additional information number 1. The current unlevered equity beta is 1.4 for Dansoft Limited and 1.5 for the soda processing industry, respectively. The gearing number 2. The gearing in the soda processing industry is on average 40%. Hence, the capital structure comprises 40% debt and 60% equity. 3. The return on market portfolio is 15%. 4. The risk-free rate of return is 12%. 5. Debt finance is considered to be risk-free. 6. Hamada model should be used to determine the leveraged equity beta. 7. The cost of equity will be determined using the CAPM. 8. The corporation tax rate is 30% required. Recommend the suitable discounting rate for the new investment if the directors were to finance the project as follows. Roman 1. 20% debt, 80% equity, 4 marks. Roman 2. 50% debt, 50% equity, 4 marks. Then you are given the Hamada model formula, and the candidates who sat for this paper were very lucky. It's very rare to have the examiner provide a formula. Here the Hamada formula was given. So we are first going to answer part 1. Recommend the suitable discounting rate for the new investment if the directors were to finance a new project at Roman 1, 20% debt, 80% equity. B1, 20, we are calculating first of all the discounting rate. At 20% debt, 80% equity. The discounting rate. Now, the discounting rate here will be the weighted average cost of capital. The weighted average cost of capital, which we know is equal to the cost of the levered firm times the equity to total capital plus cost of debt, 1 minus T, that is the cost of debt, times D over VL. So that's the formula. Do you have the cost of equity of the levered firm? No, we don't have it. Do you have the market value of equity? The market value of this is a ratio, equity to the total market value of the shares. Then there is this other ratio, okay, which I think we have. Here it is. This is the total debt, that is the total equity. So we'll get this from the question. But we first of all need to calculate the cost of equity of the levered firm. Okay? Levered firm is a firm that has debt in its capital structure. Like in this case, you see the debt is 20%. So what is the cost of a levered firm? Now, the cost of a levered firm, is equal to the risk-free rate plus the levered beta into RA minus RF. You understand? This is the cost. So do we have the risk-free rate? Yes, we have the risk-free rate. The risk-free rate is 12%. Now this is what we are told in the question to use the Hamada model. We are told the Hamada model should be used to determine the levered equity beta. The levered equity beta. The levered equity beta. The levered beta. We use the Hamada model, which we know is equal to the unlevered beta. Unlevered beta into 1 plus 1 minus t. This is provided, candidates, in the formula. I mean, the formula is given in the question, d over e. But don't expect the examiner to give you the formula all the time. It's important for you to memorize this formula. Memorize this formula. So the unlevered beta, we have it in the question. The unlevered beta, we read that the gearing, not number 1, the current unlevered beta is 1.4 for Dance-Off Limited and 1.5 for the soda processing industry. So we use the 1.5 for the industry. That is 1.5 into 1 plus, this is 1 plus this ratio, which is here, okay, 0.2 over 0.8. This ratio we multiply by 1 minus t. This is 1 minus 0.3. Okay, so this will give us the levered beta. So I have 0.2 divide 0.8 plus 1 times 0.7 plus 1.5. So this is equal to 1.763. That is the levered beta, which we need to, in calculating, we need here to calculate the cost of the levered farm. So we have 1.763. The market rate is 15%, 15 minus this rate 12%. So this gives me 1.763 times 3 plus 12. This is equal to 17.289. Percent. That's the cost, which I come and insert here, this one. Insert here, just round it off to 17.3. That's 17.3 times the equity here ratio here is 0.8. Yes, equity 0.8 plus cost of debt. We read in note number 4 that debt finance is considered to be risk-free. The risk-free rate is 12%. We have 12%, 0.7 times the ratio 0.2. This is the ratio 0.2. So this will be equal to the weighted average cost of capital, which is the discounting rate. 17, I'm calculating 17.3 times 0.8 plus 12 times 0.7 times 0.2, 15.5. 15.52%. That is the weighted average cost of capital. Weighted average cost of capital. That is part A. Weighted average cost of capital, which is the discounting rate. We are required to calculate, to recommend the suitable discounting rate. I'm reading the requirement. Recommend the suitable discounting rate for the new investment. For the new investment, if the directors were to finance the new project as follows: 20% debt, 80% equity. 20% debt, 80% equity, the discounting rate 15.52%. I'm moving to answer part Roman 2. This is 50. What will be the discounting rate at 50% debt and 50% equity? 50% debt, 50% equity. The formula remains: work is equal to K, cost of levered firm over E over V, plus KD 1 minus T D over VL. So we're going to use the same formula, CAPM. Using CAPM, cost of the levered firm is equal to RF plus beta of the levered into RM minus RF. So we need to calculate the levered beta. We use the same formula we used here. It's equal to beta of the levered beta. We use the same formula, levered beta into 1 plus D debt equity ratio 1 minus T 1 minus T. So this will be equal to 1.5 is the unlevered beta from the question, 1.5 into 1 plus 0.5 over 0.5. This is equal to 1 times 0.7 is 0.7 plus 1, 1.7. 1.7 times 1.5, 1.5 times 1.7 is equal to 2.55. That is the levered beta, 2.55. Now using CAPM, we use this levered beta to calculate this cost. The risk-free rate remains at 12% plus the levered beta 2.55 into 15% the market return minus 12%. So this will be equal to 2.55 times 3 plus 12, 19.65%. So we are going to use this 19.65% to calculate the work. 19.65 times 0. Equity 5 plus cost of debt 12% times 0.7, the ratio 0.5. Therefore, work will be equal to 19.65 times 0.5 plus 12 times 0.7 times 0.5. Take it again. 19.65 times 0.5 plus 12 times 0.7 times 0.5. This is equal to 14.025%. That is the discounting rate, where debt is 50%, equity 50%. Where debt is 20%, equity 80%, the discounting rate is 15.52%. The question is, recommend the suitable discounting rate. So the suitable discounting rate is 14.025% because that is the least or the lowest. How many marks? 4 marks, 4 marks. 1, 2, 3, 4. 1, 2, 3, 4. 4 marks. 4 marks. And that will mark the end of this question. We've done question 1 that was tested in April 2022. Part B, we've done it, that is 8 marks. We did part A, 12 marks. So thank you for attending this session. Go through the video one more time, and you realize that the questions are not that difficult if you have the formula, if you know what steps to use or to follow when determining what is required. For example, in part A, you are required to calculate the adjusted present value. Step number 1, put down the formula. These are the inputs. Then you are guided by these inputs by reading what is provided in the question. That becomes easier. The same thing with the part B of the question. You have to calculate the discounting rate. So you need to first put down the formula for the weighted average cost of capital. Then you check from the information given, do you have the inputs? And the examiner must give the inputs. So you just need to know how to read. All right, if you know how to read English, then you'll be able to determine the inputs. So thank you for your time. I hope to see you in our next lesson, where we are going to attempt question number 2. Try and do it before you come to that lesson. God bless you. I remain truly yours, Philip Sagwa. Bye-bye.